I think everybody who had got funding has left, and I think the only people who are here, I assume, would be people who would be looking for funding. Um, just to get a sense of the house, how many people here have ever tried to raise capital from anywhere, whether it's debt or whether it's venture capital or from investors? Just raise of hands. Has anybody had previous experience of, can we have the house lights on, please? Is it possible to get the lights on? Yeah, sorry. How many people have had any experience in raising capital in the... Okay, nobody has... Okay, there's only one person. How many people here think that their business could do with some capital? That you would, at some stage, whether at this point of time or the next 6 months, 1 year or so, would be looking for capital to growing your business? Anybody here? So I think, most of the businesses, if you have to scale up a business, whether you're in the technology business, whether you're in the services business, whether you're a social enterprise, I think in the morning session itself it was clear that unless you have capital, it will be difficult to scale up businesses. The good part also is that there is a lot of capital available for early stage ventures. What I mean by early stage ventures is it could be as early as concept stage companies that are raising capital, or early growth stage companies. And of course, there was always capital available for large companies or growth stage companies, whether that was from venture capital funds or whether it was a primary markets and so on and so forth. It is also often very heard that there is no dearth of capital in India. There is a lot of capital available. But at the same time, it is also true that most people who have tried to raise capital, who have tried to go to venture capitalists or angel investor groups and so on and so forth, have found it difficult. To give you some statistics, in groups, angel investor groups like the Indian Angel Network or Mumbai Angels, they get about 4,000 to 5,000 plans a year. Out of those, maybe about 30 or 40 plans are given what is called a term sheet, which means an interest of investing in those companies. And about 15 to 20 of those companies get invested in. And the reason is not because there is lack of capital or there is less capital available for investing in good companies. It is because they have not been able to find enough companies to invest in. And that is the crib that most early stage investors in India would talk about, saying that good companies are very difficult to find and spot. Now, it's unlikely that out of the 3, 4, 5,000 companies that present to these people, you wouldn't find about 100, 200 good companies to invest in. That's not the case. The problem, however, is that the communication or the articulation or the value proposition that gets communicated to angel investors is not in a manner that would make sense to most people. Now, if it was only about 50 companies that one had to look at, you could look at and scan and look at in details of everything that was given in the deck and or the business plan presentation, etc. But that's not the case. When you're dealing with 5,000 companies, there will have to be some filters that you will apply to see which are the 10, 15, 20, 30, 40 companies in that week that you will evaluate them. The issue in my mind, therefore, and having run an angel investor group, been an angel investor or a mentor myself, I can see that a lot of companies are very weak in presenting their business plan or business case. And in the next 15, 20 minutes, I'm going to run through what it takes to make a good business case or a business plan presentation to an angel investor group. First of all, you need to recognize that there is not one class of VCs. The VCs are venture capital firms, so people who invest in return of equity. There are different kinds of investors, and each of these investors participate in different stages of a venture's journey. There is something called an angel investor. There is something called then a early stage VCs or seed stage funds. And then there are VCs and private equity funds of doing that. Now, each of these it's the same class of capital, which is they invest money in your company and they take equity into your company. But all of them participate in different stages of your company and they bring in very different kinds of value. The reason why they participate in very different stages of the company is because the risk stage of the risk of every business is different in every stage. So if you see the first one, for example, when the angel investor participate, that is the highest risk stage. It is a stage where the concept is yet to be proven. ये idea चलेगा कि नहीं चलेगा, ये काम कर पाएंगे कि नहीं कर पाएंगे, will the customers buy, will the customers use, and so on and so forth. All these questions are yet to be determined. All of these assumptions that you have onto that business are yet to be proven. And therefore, what is required at the early stages is to go out in the market, test something, experiment, doesn't work out, come back, think about it, adjust it, and go back. So the assistance that you require at that stage is people who will be able to guide you with that and help you deal with the uncertainty and the fluidity that you need to have in the market. After you have gone through that stage, and typically that takes anywhere between 6 to 24 months, depending on the kind of businesses that you are in, to have your business model and the concept and the price points and some of that fixed. Once that gets in, you get into the early stages of a business, which means you have discovered a certain set of things that work, and now is the time for you to expand, saying that I've done it in a pilot or a small scale, and now I want to expand that and start implementing that on a slightly larger scale. That is the stage in which some other class of, or the other type of investors in the same class will come in, which is seed stage funds. This is the first round of, say, for example, institutional funding that will come in, or VCs who have a declared interest in participating in early stages of the journey. The reason why they participate here is because they get in a very different kind of value to the business. This is about then starting to build an organization, starting to build processes, starting to start focusing on different things, and so on and so forth. And then when you go on to the next level is when you have what is called private equity funds, where the capital. Now, if you think about it, the risk starts reducing as your business progresses. At the early stages, you had the concept risk, execution risk, scaling up risk. After the first stage, the concept risk is taken out of the play. Now it's execution risk. In the third stage, it's only the scaling up risk. But also, as you start moving through the phases, the requirement of, while the risk per se has gone down, the amount of capital that is required to start to get deployed in that business keeps on increasing, and that is a primary difference between who comes in at what stage. So if you look at it, if you are at the concept stage, or it could be at a PowerPoint stage, saying ऐसे कुछ करने जा रहा हूँ, and you've got some broad thinking around it, or you've got a proof of concept and you require anywhere up to say about 5 crores or so. You would go to angel investors, and there are enough angel investor groups available in the country today. I was trying to find Sandro, who represents the Indian Angel Network in Delhi, but I think he's up. These funds would typically invest about 5 crores also. Typically, it would be in the range, most of the investments are in the range of about 2 to 3 crores, that usually what they call as the sweet spot. But this is enough capital that is required by most businesses to sustain about 12 to 18 months of the first initial testing hypothesis in that market. This is not the, so therefore, when you go to these guys, you make sure that you're going there for saying, look, I have a concept, I think this will work. I have tested this with people. Now I want capital to deploy that and test whatever I have discuss with people and test that in that market. Ask only for that much capital, because they are not going to fund the scaling up part of it. If you go to them saying that, look, I will first test it, and after this works, I need another 5 crores, and therefore my total capital requirement is 10 crores. While that 10 crores requirement may be true, this is not the group that is going to participate in this. And I often give the example of education. Think of it like a play school, school, and college. You go to all of these three are in the business of education, or they are all three are educational institutions, but you go to them at different stages of your business because they participate differently. Similarly, you go to these businesses at a different stage. After you've done this first round is when you will go to an institutional set of investors like VCs and so on and so forth, etc. Now, why do investors invest in your company? Investors invest in who is an investor at the end of the day? Either an individual angel investor or a VC fund. They are looking at investing in a company as an asset class, much like they would invest in commodities or real estate or the stock market or different kinds of assets that they will put their money in. investing in startups is also an investment class that they will participate in. And so therefore saying that, look, I have this concept, nobody else is doing this in India, I think because of that, I think this product will work. Sure. But at the end of the day, what they need to understand is, what is the business case? If I put in this much money, what is the likelihood of me getting whatever X times of capital? And we'll come to that in a minute. The biggest challenge or the problem that I see when investor or when startups are presenting to investors is that they keep on talking about the product or the technology, or this is the nobody else is doing it, why am I different, etc. All that is important and all that is good. But what is more important for the investor is that apart from the product, what is the business that you're being able to build around that, and what is the business case that I will have as a result of investing in your company. Now, you also need to understand how the investor's business works. An investor typically at the early stage, when you're talking about concept stage companies, an angel investor is looking for about 8 to 10 times the return that the money that they have put in. And this is not because they are greedier than the other class of investors. This is only because the failure rates at the early stages are so high that this is the kind of capital returns that they will require to be able to justify that. To explain that mathematically, if angel investors invest, say, 1 crore in 10 companies at the beginning of the year, in about the second or the third year, out of those 10 companies that they've invested in, maybe 5 or 6 will cease to exist, they will die. And that's okay. That's the only way the game can be played. That's a high-risk business. Out of those 10 companies, maybe 2 or 3 of those companies would return them, capital a little more, maybe 2x, 3x or so. Now, they've invested 10 crores. If they're invested the same 10 crores in the stock market, in about 5 years' time, this 10 crores would have been 20, 25 crores. Now, they should not be expecting any other that's the kind of minimum return that they should be expecting. So it's now up to that 2 or 3 companies that are surviving to deliver to them 20, 25 crores of the 10 crores that had invested in. So therefore, if you succeed, you are essentially paying for the failures of others. But likewise, the only way this can work is because if you fail tomorrow, somebody else is going to pay for it. And so therefore, investors look for 8 to 10 times the return. So if you go to them saying that, look, I think my business will be profitable in year 2, but it will be a smaller business, they are not interested. They will be looking at what is the way in which the valuation going. This is not to say that in businesses that cannot scale up is not a good business. It can be a good business. You could be a 10 crore, 5 crore business and be profitable and earn a lot more than what you would have got in a job. But that will not be a VC fundable business. So that will not be an angel investor fundable business. Perfectly all right to have a small business, but then you have to make sure that your choice of investor is very different. Now, there are 3 criteria that investors look for, and whenever you are talking to an investor in a presentation, these are the 3 points that you need to be able to convince them about. And whether your presentation is 3 slides or 20 slides or 20 minutes or 2 hours or 3 minutes, it doesn't matter. These are the 3 points that you will need to convince them about. First, is the market size large enough? When I talk about large enough, it's not about 50, 60, 100 crores. It's about, is this market size 1,000, 2,000 crores. Again, I'll explain to you why it is important to investors to have that. Assume that somebody invests 2 crore in your company and they take 20% equity in your company. And by the same logic of what I had explained earlier, in 4 years' time, they should have that 2 crore should have become 20 crore, right? Now, they've taken 20% equity in your company, and their expectation is that this 2 crores should become 20 crores in about 4 years' time. Now, for this 20 crores to become 2 crores, your company will have to be worth 100 crores because they have 20% equity in that company. Now, unless therefore you are a 40, 50, 60 crore company and hopefully you will get 1 or 2x multiples of your revenues, or maybe at least 20, 30 crores to get 3 or 4x revenue of your company, it will not be possible for investors to get a 10x return on that. So if you say that, look, in 4 years' time, I will be a 8 crore company and I will be extremely profitable. No problem. All that is good. But does that help the investor? No, it won't help the investor, because an 8 crore company, even if somebody were to give you a 2x return, you are still a 15, 16 crore valuation company. 20% that I own in that is 1.6 crores. I've invested 2 crores in that. I've got 1.6 crores. Doesn't make sense for me to invest in that company. So one, the market has to be extremely large. Secondly, even in a large market, the product, service, concept, whatever you have, has to have a reasonably strong chance of being a dominant player in that market. There's no point in saying, but according to Gartner and according to this and that, the market is $20 billion. All that is fine, but if all your aspiration is to be a 8 crore, 10 crore, 15 crore company, it doesn't matter. Unless you have an opportunity of being among the top 5, 6, 10 players in that market, and of course different markets have different number of winners. In the restaurant business, for example, you can't hope to be in the top 5 because there's no top 5. But if you are in the e-commerce space or if you're in the recruiting space, etc., you will need to be among the top 3 or 4 guys to be to even survive. Otherwise, you don't survive in that marketplace. And this is not just about saying that, is my product unique? This is also often a question of, do I have the right team? Flipkart was not the first e-commerce company, but they were a great team and were able to build in a great set of players doing exactly the same business that many other e-commerce companies before that were doing. So it's a question of what is it in this team or the product or the concept or service that can give investors the confidence that this business has a reasonable chance of being a dominant player in that marketplace. And therefore, your aspirations, your everything else that you do has to be able to communicate that to the entrepreneur. And most importantly, whether all of this, markets, all of this is good, even if all of these are true, the third factor, most important factor is that, is this the team that I will bet on? And the reason is because a business plan at the end of the day is a set of assumptions. It doesn't matter. मैंने आज Excel sheet ऐसे लग दिया, कल दूसरा assumption करता हूँ, थोड़ा ऐसे हो जाएगा. It doesn't matter. You need to have Excel sheets, of course, because that gives you some sense in how are you going to go and stuff. But that Excel sheet doesn't have any meaning. That Excel sheet is only a set of saying that I think we will go in this direction. The reason why they bet on an interesting team, and this is the most important criteria, provided the first two are okay, is because you need teams that have a certain amount of passion, a certain amount of competence being able to do that, because all of this adjustment is required. A bad team will do a bad job of implementing a good quality plan, but a good team will make a great job of implementing even a B quality plan. So the team has to be good, and the team doesn't mean that you've got all your bases covered, but at least a couple of 2 or 3 people who've got passion about that. Ideally, a team that has complementary skills, somebody from technology, somebody from marketing, one person from the domain, etc. And if you don't have that, that's not a showstopper. What you need is the willingness as a founding team to understand what you lack as a team, and the willingness to bring in other people with some level of equity or some level of participation in the upside. You can't afford cash at the early stages. You can't afford, say, for example, a great supply chain and logistics expert from Flipkart to come in and head your supply chain division as a startup, and you don't need that as well to pay that guy. But you certainly have, as one of the speakers in the morning talked about, you have equity, which is a currency that you can use, and therefore your willingness to be able to do that is important. Typically, you'll get about 20-30 minutes into your presentation. Keep as little time as possible on talking about the product and the technology, on how good the technology is. Most entrepreneurs, because you see, when you build something, you're very passionate about it and you want to talk about it, all of that. We fail to recognize that the other person's interest or passion for that product is not necessarily going to be as high as yours, and need not be as well. And they don't understand it as well. I mean, today, for example, I'm not a doctor, I'm not a healthcare specialist. So if I'm looking at a healthcare plan, I need to understand what is the business of that healthcare plan, rather than how this cardiac surgery is going to happen. You keep on telling me more details, I will keep on getting more lost about it. What I need to understand is, okay, what is the operating plan onto it? How is this going to be implemented? Where are the customers going to come in from? Where are your staff and resources going to come in from? What are the markets you're going to address? What are your plan A, plan B, and so on and so forth? Good products are important, but they are not a sufficient condition for success of a company. And unless you're able to build a company or a business around that, that won't work out. So in a 15, 20 or 20, 30-minute presentation that you should have, give enough about the product to tell the person that I understand how to build a good product or a good service around it, but spend enough time to help that person understand the business around the entire thing.